So this is a problem because what this means is if you have customers selling or targeting customers outside their state, they potentially have exposure in other states. The Quill court case, this is in 1992, and this is what we were all more familiar with. This is that physical presence standard. And so physical presence is exactly what it sounds like, where if you hire an employee in a state, you now have nexus. And this term nexus is basically saying now that state is legally allowed to tax your business. They now have legal ability to say, hey, you're inside our state and you're doing business in our state. We now can tax you to some extent. So it's a threshold you have to meet to be subject to taxation in that state. But of course, now the entire world is online. So the states basically increasingly over time, we're getting very frustrated because a company may be in Texas and then they sell $10 million worth of business into California, but because they don't have an employee there, they don't have a warehouse there, they can avoid all California tax. So that's the type of situation where a state would get very frustrated being like, you are using all of our customers, but us as a state are not getting to benefit off of that, off of those sales. And so that's where the states always want to tax as many people as possible. So when you think about, like if Texas was allowed to say, okay, we're going to create a rule that every Maryland customer is going to pay us tax regardless of whether they're in Texas. Like if Texas was legally allowed to do that, I think they would, right? Every state would love to tax the people that don't vote for them to be in office. All the states would just tax the people that aren't their residents. And the only reason they don't is because it's not constitutional. And so that's where we're going back to these court cases. These are US Supreme Court cases of, okay, that's great, you want to tax everyone. Well, we're going to impose this limit of like, if they don't have enough contacts with your state, you were just legally not allowed to tax them. So that's why someone in Texas doing business in Texas, selling to Texas customers, Maryland can't tax that person legally. And so that's going back to that physical presence test. But they may be able to tax them if you say, hey, I'm a Texas business, but I hire a Maryland employee. All of a sudden there is some exposure of maybe I can get taxed by the state of Maryland. And that, just going back to again, like this is why. It is because it is the constitutional limit on it. Now, what happens is in 2018 with the Wayfair case, that constitutional limit was just blown wide open. States over time were saying, hey, this physical thing doesn't make any sense. Like I want money. If they have any contacts with my state, even if it's just economic, even if it's just virtual, I think we should be able to tax them. So what happens like with any court, right? Tax court, Supreme Court, with any court, people challenge the rules. Basically what states end up doing is creating rules that they think are constitutional if they make it all the way up to the Supreme Court. And that's what ends up happening, where of course it involves Wayfair, virtual, they wanted to tax Wayfair, and they won. And so what happened in Wayfair is it completely overrode this physical presence standard, which doesn't always happen for court cases. Sometimes it'll just define some additional rules. This one actually threw out this standard. It said, okay, times have changed, this is different, this is a better standard. And what they created was this economic nexus standard. The idea being if you have enough contacts, even if it's virtual, you can legally tax that business. Whenever there's a court case and a result, what happens is people have to interpret it and figure out like what exactly, even though this was for this specific scenario, like what is this impact? And I think that's why we're seeing a slow impact here, at least psychologically for accountants, for people, because this case specifically directed with sales tax. So there's always that open question of, well, is this only for sales tax or is this for corporate income tax? I think at this point it's pretty clear that it does apply to income tax as well. So this is a problem because what this means is if you have customers doing like selling or targeting customers outside their state, they potentially have exposure in other states. I don't know about you, but I have plenty of clients who do that and they will come to me and they've only ever been filing one state return for the last 20 years, even though they may not even have any sales in that state. They may be only selling to all these other states. And so the first thing to note there is there's exposure. Tripping the Wayfair standard is easy. So I want you to view this as like some states, it's literally you do $1 of business in my state, you owe me a tax return. Now granted, we've tripped that Wayfair standard a lot of times, but then the second analysis is what's the real exposure? So if you trip that Wayfair standard in a state that the tax would be $0 or it would be $10, that's also an evaluation to make, because even for them, it's administrative compliance, right? I don't think this was always intended. They don't actually want to chase millions and millions of business owners that owe them $100 each year. So a lot of states They just never, what happened is Wayfair busted open the rule, and then the states didn't have specific rules in place to contain it or to give a clear bright line. And that's why I call it like the Wild West, because this case now legally allows them to tax, but a lot of states keep their doing business standard extremely vague. So then technically we might be looking at a dollar standard right there. Do they actually want millions of business owners to file if they have $1's worth of business in their state? Probably not. So that's part of the issue, where we've basically got potential for like unlimited compliance here with all of these states.